Good morning, everyone. Wonderful to be here at this year's fantastic Fintech Nexus. And I'm so happy to be here with you, Caitlin. As everyone knows, Caitlin is the CEO and founder of Custodia Bank, had a long career on Wall Street, Harvard Law School, and Kennedy School also. Really a very distinguished career. And you now find yourself on the front lines of regulatory challenges as we try to figure out what's going to be the shape of the industry as we bring crypto and digital assets into the mainstream.
Yep.
So I want to start, I'm sure a lot of people know it, but begin by telling us the story of your effort to connect with the Federal Reserve payment system and where that stands.
Sure. Going back to 2018, the state of Wyoming was getting into the enabling legislation to define what digital assets are under commercial law so that judges had a roadmap for adjudicating disputes. Those of you who are attorneys will recognize this as the Uniform Commercial Code, some of the very basic foundational things that needed to get set in place in order for this asset class, which didn't fit, still doesn't fit, in any of the traditional buckets, money, securities, or commodities. And so Wyoming set about to give this industry, the legitimate players in this industry, a home by defining a lot of that. And so one of the things that the state legislature heard was from legitimate entrepreneurs who lost their businesses due to the first iteration of so-called Operation Choke Point. There was a big debanking of all digital asset companies in 2017. There was one, by the way, in 2013, and of course we're in another iteration of it now. But long story short, the idea was create a pathway to legitimize by regulating the lawful companies in this industry. And it was actually Commissioner Faulkner of the Wyoming Division of Banking who came up with the idea of an uninsured bank charter. Now, this is a fintech conference. A lot of folks probably don't realize that there are such things as uninsured bank charters. Many of you were involved in the OCC payment charter effort. That was effectively the same thing as what exists in 5 states today, which is uninsured bank charters. These are actual banks, ergo eligible for Fed master accounts, but they're uninsured. And the 5 states that have these charters, it's an eclectic mix. It's Connecticut, Maine, and Vermont in the Northeast, and then Wyoming and Nebraska in the heartland. And it's interesting because they are legally depository institutions. So if you step back and think about the regulatory structure in the US, you're either a money transmitter if you're a fintech, or a trust company, or you might be able to become a bank. And if you become a bank, you're either federally regulated through the OCC, federally chartered, or state chartered, and we would include ILCs in there because, of course, there are some fintechs that have ILC charters. But the uninsured state charter was pretty much dormant. Connecticut has had a number of them, about a half dozen of them. The most famous one, of course, was TNB, the narrow bank, that tried to get a Fed master account, sued, and is still waiting 5 years later. But interestingly, as I dug into the research, I didn't realize UPS actually bought a bank, which a lot of folks will be surprised about because of the separation of banking and commerce. But what they did was buy a bank and convert it from an FDIC-insured bank to the uninsured Connecticut charter. They did this 20 years ago, and it was a commercial finance company, and that's how they were allowed to own it. So there is a very powerful fintech charter, which is the uninsured state bank charter. Not a lot of folks understand that that's there, and it's existed since around 1990 in several states.
And then in recent years, Wyoming has set out, you mentioned Albert Faulkner, set out to be the crypto capital of the world, perhaps, something along those lines, and tried to create a welcoming regulatory environment. Share with the audience exactly what it is that Custodia Bank does and what is blocked by your not being able to be a Fed member?
Yeah, so Custodia Bank is not yet taking third-party deposits or third-party funds. Stay tuned, we will soon. But the Wyoming Special Purpose Depository Institutions are uninsured state banks. You do not have to be a digital asset company to use the charter. Just like in Connecticut, there are non-digital asset uninsured banks. And the whole concept is if the FDIC is not going to insure crypto, which it was made very clear from the early stage. The FDIC doesn't want to insure a lot of fintech, right? So, okay, in the US system, you're either FDIC insured, in which case you can be a bank, or you're in this other category. But what we worked on and what Custodia Bank is in this other category of a depository institution that is legally allowed to accept to receive deposits. That's the phrase. You receive deposits of US dollars. That's what makes you not a fintech. If you're a depository institution because you have the statutory authority to receive deposits, you're not a fintech. You are therefore, under federal law, eligible for a clearing account at the Federal Reserve. So the concept here is that the state in the case of the Wyoming Special Purpose Depository Institution, there are special rules that you can opt into for digital assets. And a lot of folks look at what happened with FTX, and by the way, I've been very outspoken about the fraud and crazy leverage in this industry. There are still huge parts of the digital asset industry that need to burn on a raging funeral pyre. Still today, okay? And that's what's sad about the fact that there has been such an extensive effort. Wyoming, by the way, didn't do this in a vacuum. As we were talking backstage, there were more than 100 meetings between Wyoming officials and Federal Reserve officials to create this charter. The Fed was providing comments on the draft legislation, on the rules, and on the 750-odd page supervisory exam manual, which covers BSA for digital assets, and was prepared by Promontory with the state of Wyoming. All that's public, went through all public processes. But the point is, the Fed was actively participating. And so when Wyoming chartered the first 4 of these special purpose depository institutions, all 4 happen to be digital asset specialists. Again, there are others that are in the pipeline that are not. But unfortunately, we applied for a Fed master account, multiple of us did, and everyone's in limbo. Custodia is the one that pushed the hardest to open the path. And was denied.
You were denied, and there is litigation developing?
Litigation pending. I obviously can't talk much about it, but just the public information is we filed the suit, Custodia did, against both the Kansas City Reserve Bank and the Board of Governors. And it is publicly disclosed in the suit. We filed that in June of last year, publicly disclosed in the suit that the Kansas City Reserve Bank told Custodia there were no showstoppers about 4 or 5 months after we initially applied for our Fed master account, and then suddenly everything stopped.
So I think it would help to hear your view of if we do everything right from a public policy standpoint, and if, as you say, we're able to squeeze the bad actors out of the sector and so on, what should the system look like? What should the role of the banks be in the crypto world? How should these banks be regulated? How will we make life better for the public if we proceed along the lines here? Help us paint the picture. Yeah,
leaving all the regulatory details aside, let's step back to first principles. Yeah. What do we have here? We have a new payment system. And for fintech companies, it's particularly interesting because it's all technology-based and it's all API-based. We're not dealing in analog money anymore. We actually have digitally native money. That is a radical concept. Dollars do not exist digitally natively. They are created analog through the banking system, and so therefore they're not programmable, they can't be used easily in software. Even if you are doing a form fill for a FedWire instruction, it's still just form fill. It's still going, you're really just digitizing analog data. But once it's natively digital, now you can do a lot with it, okay? So what do we really want? We want these two systems not to blow each other up, okay? Do it in a safe and sound way. But you've got natively digital dollars in the form of stablecoins from the digital asset sector. Here's the problem. They settle in minutes with finality, irreversibility. And the banking system, clearly we now have known, and we don't even have to talk about it in conceptual terms anymore, it can't handle fast settlement of payments. Holy cow, even online banking blew up a few. Now, all that said, I was looking at the banks that were serving this industry and warning, going back to 2020, that there were going to be liquidity issues with stablecoins. Why? Because I looked at the banks that were serving the digital asset industry, and they were holding less cash on their balance sheets than they were holding deposits from stablecoins. And I knew if there were going to be a zero-day exploit, this is new technology, right? If there were going to be a zero-day exploit in a stablecoin smart contract, that was going to take Signature Bank down because they had less cash than they had deposits from USDC. So it was obvious when you looked at the financial statements, there were going to be problems. And unfortunately, what we've had to learn the hard way is it wasn't just the fast settling stablecoins that caused those problems. In fact, that didn't cause the problem at all. It was pure old, boring old online banking, right? Because online banking enabled $42 billion of deposits to be withdrawn from Silicon Valley Bank within the span of hours. So as we sped up the settlement, to answer your question directly, as we speed up settlement, banks have to hold more liquidity. So what you really need is banks that are designed to be highly liquid, handling all of these assets, which means they can't be engaged in maturity transformation, and therefore it has to be a new breed of payment bank, a gateway bank, if you will.
And you've written about connecting this to the idea of a so-called safe bank.
Yes.
You've also said something along the lines of crypto and leverage
Do not
can't
mix.
go together, period. Something
Period.
like that. Yeah.
Correct.
So you envision a new class of banks developing from what you're describing, and if you took us forward 5 or 10 years, what do you think the industry would look like?
Well, it's so fascinating because there's a real bifurcation between the US and the rest of the world, okay? The internet knows no borders, and nor does this technology because it's internet native money. It's internet native technology. So I just came back from a conference in London with one of the big consulting firms, and they have gone all in on this technology. They have built what is effectively middleware. They're calling it a layer 2 on Ethereum that allows straight-through processing from ERP systems to treasury management systems to the payment systems at corporations. And this is one of the big 4 consulting firms. Okay, they are all in on an open public blockchain. And it was interesting because they had me come and do a keynote, and I was at first kind of curious what were they interested in. And then it hit me as the head of their group was talking that they needed somebody to fight the fight for open public blockchains, because the US is trying to shove it all offshore. And by the way, getting exactly what the regulators fear, which is that it's going into the shadows and exploding in size in the shadows. Just yesterday I was looking, Tether, which is notorious for illicit finance and opacity in its disclosures because they deliberately do not come on shore in the US, so they say. Tether is almost at its all-time high. So now, I think what happened is the regulators, we were chatting backstage, what do we speculate happened? I think a lot of it is just fear, and they believed that if they tried to shove it out of the US banking system, that it would die. Holy cow, it hasn't died. It is flourishing in a big way outside of the US. The vibe at the conference in Europe was so different than the vibe at the conference here. The BIS is allowing banks globally to hold up to 5% of their tier 1 capital in Bitcoin and Ethereum. Whereas in the US, you can't even hold it a de minimis amount just to pay transaction fees. Okay, so the US has diverged massively. So if we look ahead 5 years, given that the US has diverged massively, what's going to happen? It's just going to flourish offshore. And the US is going to figure out that it didn't go away like they hoped that it would. And frankly, they're playing whack-a-mole as it pops up in different places, causing problems like it just did with Signature and Silvergate. And I think they're going to rue the day that they made this decision to try to shove the whole thing offshore and hope it went away, because it isn't going away.
I know that's part of your message. This isn't going away, so we have to figure out how to integrate it. So I'm sure we have a lot of regulators in the audience. Do you have advice for people in policy and regulatory roles in terms of how to map a journey here, or even on how best to work with innovators? I noticed that you just within the last few days were named by the American Banker as a top innovator in the industry. And you are obviously innovating in this industry. So what do you wish that regulators might keep in mind or might understand that you think they might be missing now?
Well, this might be a pipe dream, but unfortunately, money talks in Washington, D.C., and those of us who did not spray money around weren't at the table. And folks like Sam Bankman-Fried seemingly had free reign. He met with Jay Powell for an hour. Who gets a meeting with Jay Powell for an hour? So it is stunning how unfortunately the wrong folks were being listened to. And in reaction, there's been this overreaction to shove the whole thing offshore. And it's interesting because talking to folks from the big banks, they've had the same message from US regulators. Don't touch these open, public, permissionless blockchains. Meanwhile, you've got a big four consulting firm openly building on one and working with, with multinational corporations to integrate the whole thing through ERP systems. That's ultimately going to clash. I mean, it just is. And I was talking to a US trust company that was debanked, of course, as they lost both Signature and Silvergate. And they're getting their US dollar clearing from UK and Singapore banks. It's crazy, but this is happening, right? So the point is, it's not dying. It's just gone offshore into the Eurodollar market. And I've written a lot about the Eurodollar market. The Fed really had a problem with offshore banks. The history of the Eurodollar market is, by the way, back in the 50s, Russia, because OPEC was only selling oil in dollars, the oil market was a dollar market. And because of sanctions, Russia couldn't keep its dollars in US banks. And so the British banks said, well, we'll make a market in US dollars. That was the birth of the Eurodollar market. The Fed had no control over that. US bank regulators had no control over that. The Eurodollar market grew up to be bigger than the onshore domestic market. And the Fed is trying to wrestle that back in through the shift from LIBOR to SOFR, right? LIBOR, London Interbank Offer Rate. The LIBOR panel is predominantly European banks. And so in the 2008 financial crisis, when LIBOR spreads blew out because the creditworthiness of European banks was under question, that actually brought a lot of distress onshore into the US that had nothing to do with the US itself, because it was European bank credit spreads. So I know the New York Fed has made a huge effort to try to rein that in, to get a secured overnight funding rate, SOFR, that the Fed itself controls. That is aimed at taking back the power from the Eurodollar market, and I support that. The US needs to do that. It's going to make the financial system more stable, but it's really funny because it's like pushing on a balloon. They're really pushing to bring LIBOR into SOFR to get control of the Eurodollar market. Meanwhile, they're pushing a whole new version of the Eurodollar market, which is all digital asset activity, into a new version, and it's just going to be another whack-a-mole problem for them.
We only have a moment left, but maybe to close, I think it's clear that a great deal of the regulatory community and a great many other people look at these innovations and they see the risks. That's their job.
There
to
are.
deal with the risks.
Yep.
And don't really see the upside. Other than maybe the defensive upside, you're saying it's going to happen anyway, so we need to regulate it. But what would you share as to how the financial system would be better if these changes?
Yeah, I'll give you an idea. Probably everybody in this room has dealt with the SWIFT black hole. Moving money globally is just an acknowledged pain point. And there is a manufacturing company that I'm aware of that used USDC because they had an opportunity that was short-lived. They had to get money into China same day. You can't do that through SWIFT. You can't do that through the traditional banking system. They didn't want to touch Tether, so they did it through USDC. They were able to take advantage of this and earn $2.6 million because they could move US dollars same day. And this is not some crypto speculator, right? This is a real company, a real business. That's the use case ultimately. That's the problem we're trying to solve, is take some of the friction out of moving value, allow for a lot of straight-through processing, and with the US dollar payment rails as they exist today, that's not possible.
We are out of time. I'd like to ask everyone to join me in thanking you. Fascinating.
Thank you.